Today we're going to be reviewing and defining 7 primary accounts. You're going to want to learn how to record these right off the bat to save you from headaches in the future. I'm Jamie.
I'm Mark.
And we're Social Sudo. Okay, so Mark, tell me what we need to know about recording bank accounts.
Yeah, so a bank account is something that most of us are going to just say, okay, we know how to record those transactions. But basically, if you're creating a PayPal account, if you've opened a checking account, this is where you want to differentiate between each of those accounts and track your cash flow. So anytime that you make a transaction, money's either going to inflow or outflow from any one of those bank accounts. And I would also add that as you're creating bank accounts in the age of cryptocurrency, this is also where you want to record your exchanges. So a lot of times you'll create subcategories under bank accounts. You could have your main host checking account, which is your bank. Then you can have an online account like PayPal or Square. And then you might have an exchange like Coinbase where you're tracking USD equivalent values of cryptocurrencies if your business is going to engage in that type of accounting.
And so what is a credit account then?
So credit accounts, again, they're very similar. I mean, you could have the same bank. Let's say you're banking with Citizens Bank, you have a checking account there, but then you also decide you want to open up a credit card, business credit card with that bank. You want to record any transactions that you're placing on your credit card within your credit account. Because what that's going to do is as you accrue a balance, it's going to report as a negative as opposed to a positive in a bank account. So it's very important to make sure that you differentiate bank accounts versus credit accounts. Likewise, if you have a loan, like a line of credit, this is also the place where you want to store any transactions occurring on a credit line.
Okay, and let's segue that right into how transactions are defined when it comes to business accounting and how to record them correctly.
Yeah, so you're going to be recording transactions, and unlike how you might be doing it right now, you might just go directly to your bank or wherever you track in an Excel spreadsheet for personal expenses and income. You might do that directly through a spreadsheet that's correlated with your bank. In a business, you do it a little bit differently. You record an expense or an income transaction as something that you purchase or something that you pay for, and you classify what you spent that money on. So let's just say you're getting your office built and you need to buy a printer, and you bought that printer from Staples. You're going to have an expense. Let's say you spent $300. What that expense will show is you'll correlate it, you'll connect it with a bank account, so you'll show that the money came out of a certain account, let's call it your checking account, or if you used your credit card, you could show it came off of your credit card, but then you're going to classify a sub-account as office supplies, and that office supplies is going to appear as an expense at which you're going to record. And likewise, if you have income, let's just say that you have $200 in your checking account and you earn a little bit of interest, that's going to be classified as income, generally in the form of either a refund or interest. And you'll record either of those things. So when you classify that account, you'll say, okay, it's interest or it's a refund, which are going to be income accounts.
Okay, and maybe something a little less intuitive. How about equities?
Yeah, and equities are something that as you're starting your company, everybody's going to need to know how to classify. And it's really important because this is going to save you a lot of headaches coming tax time. There are 2 primary accounts within equities. There are just your equitable contributions as a partner, and then there's also your equitable draws. Now, equitable contributions, let's say that you don't have a bank account yet set up in your business, but you want to start recording some of the transactions that you have so that you can properly account for everything since day one. So let's say you're privately, out of your own personal account as a partner, starting to buy things for your company. In our case, we've been buying webcams, we've been buying plugins, we've been buying our domain. Those transactions are never reflected on the company's bank accounts. They're just expenses or income that an individual partner needs to account for, because essentially it's the same thing as a partner saying, okay, I'm starting to give my money to the business and we need to record that as a percentage of equity that I've put into the business. So let's say you were spent about $500, then that $500 will build as equity. And the main point is once the company starts to generate a return, starts to generate profit, all partners should then basically attempt to bring their equitable contributions back down to zero. That way all partners are at a level playing field. Now, equitable draws are a little bit different. Draws is cash that you take as a partner and you directly inject it into a bank account so it becomes liquidity for your business. So if you're to open your bank account and it requires an initial $100, the partner that basically spent the $100 to open that checking account, that's going to show as a draw. It's going to show that that partner has a plus $100 gain as opposed to the other partners which are still leveled at zero. And then what will happen is as the business starts to pay its partners, once you start producing revenue and you start to earn a living, let's say that $100 gets paid back to you, it shows up as a negative balance. So that initial $100 that first partner gave, if he just was then basically paid $100, it will net zero. And any draws are going to show as a negative balance as you pay yourself more throughout time. So if you were to pay yourself $20,000 for the year of 2022, it's going to show up as an equitable draw that partner made from the company. He'll have a balance of minus $20,000, and it's a way to track how much each partner is making on a level playing field.
Okay, so what are cost of goods sold?
Cost of goods sold is another very important account that everyone needs to understand. So whenever you're classifying, let's say, an expense, a transaction within your bank account, you might be inclined to say, okay, well, a stapler that I bought for my office is just something that I needed, therefore it's an expense. But cost of goods sold is generally merchandise that you're buying and you're storing as an inventory. So if you're in the business of buying and reselling cars, then a cost of goods sold is essentially what you paid for the car that you're about to resell. So if you paid $10,000 for a vehicle and your idea is to flip that vehicle and sell it for $16,000, then the cost of goods that you're going to sell is $10,000. And it's really important to differentiate any products or services or anything that you buy that you have the intention of reselling, and you want to classify that as a cost of goods sold. And generally when you're in an account, it's actually shortened into the acronym COGS, C-O-G-S. So it's very important to sort of differentiate general income and expense transactions versus your cost of goods sold.
How about assets?
Yeah, so assets, there's two that I can come to think of that are very important as you start to track. You're also going to want to record inventory transactions. So using the same example we just used where you purchased a car, you purchased that car as a cost of goods sold for $10,000. Now in your inventory, you have a store of value valued at $10,000. And you also want to record in inventory, I have this car, and your business now owns that car as an asset. Now it's very important to track your assets in the form of inventory, because come year end, if you have $10,000 of a stored car in inventory, you're going to be taxed on that car in the amount of $10,000. If you had 10 cars, each valued at $10,000, you're going to be taxed on a net income that you've generated, which is stored primarily as an inventory. So you're going to be taxed on that $100,000 amount, 10 cars times $10,000. And you need to track those inventory assets. And we can talk about strategies in terms of trying to lessen or change your tax burdens in a later video. The other type of assets that you might accrue is things like office furniture. If you have a desk that you purchase for office purposes or needs within your business, that desk becomes an item that is an asset. It's a tangible asset your business owns. You can resell it and recoup cash down the road. But this is really important to track as an asset because wherever you're located in the world, that's property that your business owns. And that property is taxed generally by your local town. So if you're doing business in the town of Manchester, Connecticut, for example, Manchester is going to request that you provide them with a list of all property that your business owns, and you attempt to understand the value at which you paid for it and the depreciation for how long you've owned it. And you're going to be taxed by the town a certain amount, it's usually a standard mill rate based on that amount of property that you possess within your company. So anything that you buy, you want to make sure that even though you're tracking them as an expense, you want to classify it as an asset so that you can track it for proper accounting records for tax purposes.
And then let's contrast that with liabilities last.
Liabilities is the last major account that you want to pay attention to. The reason why a liability might be very important to understand day one is, let's say you're bootstrapping your company, and initially what you're trying to do is raise a little bit of funding because you don't quite have enough money. So you turn to friends and family and you take out a promissory note, and they were to give you about $50,000. That $50,000 is a loan at which you borrowed, which presumably you're going to be paying compound interest as a return back to them over the next 3 to 5 years. And that loan that you take on is going to be considered a liability. It's a liability. You owe that money to someone as time moves forward. And that's where you're going to classify those types of transactions. So, and every single year that you then pay down that loan, you're going to record the interest that you owe as a positive amount on your liability. And then every time you pay back the loan amount plus interest, you're going to deduct it until eventually your liability nets back to zero, in which case you won't have any more liabilities. The only other time that you want to classify liabilities is if you have a workforce under you. If you have employees that you need to pay, typically they have some sort of an hourly wage, they have some sort of a rate that they're going to be paid, you need to pay your employees. Those are also considered liabilities that the company needs to be responsible for. So every time that you pay an employee, you will track that the same way that you have for your partners as negative equity draws to show how much the company has paid each partner. You're going to record and track the amounts at which you paid your employees as a negative liability, so that then you can begin to track that information for your accountants as well. And I would say that those 7 main accounts are really important to just have some general idea about what they are as we begin to discuss and then create our own accounts for our own company. And we're going to walk you through how Social Sudo has built its accounts in preparation for the years of business ahead.